Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening everyone watching Kuan Yuan On. Hello, I'm Jung Johnson. Before we get started, let me just check. Can everyone hear me okay here in Chuancheng? I'm a little worried the sound might be too loud, so let me know if the audio sounds alright to you all. If everything sounds good, just type OK or something like that in the chat. Also, I want to wish everyone a Happy New Year in advance. Next week, we'll continue to do live streams in our group as usual, and we'll also be sharing some related videos with everyone. Also, on Chinese New Year's Eve, it's Martin Luther King Jr. Day, so you don't need to log in. Just enjoy your own New Year's Eve however you like. If you want to play Mahjong, go play Mahjong. If you want to watch a movie or spend time with your family, just go ahead and enjoy it. Since the markets are closed that Monday, there's no need to stress out. And then, after we wrap up today, the next session will be on Tuesday, which is the first day of the Lunar New Year. I'll be in charge of the live stream that day, so everything's set, okay? Alright, with that, I'll go ahead and start today's presentation. Alright, the main thing today, what's most important, is that tonight at 9:30 p.m. we'll have the CPI release. So in a bit, around 9:29, we'll switch over to the CPI page and check out the CPI situation together. But for now, I'll move on to the next topic, Trump compromises for votes. Why did I choose this headline? I'll share a news story with everyone. I actually think it's pretty interesting, and sometimes you can see the bigger picture from small details. Is it possible that this is actually a signal? Could it be that this is a sign of a possible shift in Trump's policies? I'll really break down for everyone what exactly happened, and why Trump might be willing to compromise for votes. And then, at the end of today's session, I'll help everyone sort out which stocks are considered industrial stocks and which ones are sensitive to inflation, as well as how they benefit. I'll also share what their current situations might be. Since I haven't covered every single stock, over the past few days, I've shown the YTD charts. So if anyone is interested, you can go back and rewatch the video, take a screenshot of that particular slide, and then look for which companies in there might interest you. This is just a simple preliminary way to help everyone do some basic screening. And I also encourage everyone to do this whenever you have some free time. Now, let's look at some important pre-market news. First up, Michael Harnett, the strategist from Bank of America, has released some new comments. Actually, since last year, he has been very optimistic about international stock markets. And this year, he remains strongly bullish on international stock markets. He said that the current overall US trade policy is indeed creating a brand new order. What does that mean? Basically, investors will put their money into other international assets. Although his statement is a bit aggressive, he talks about shifting from the US dollar and US stocks to other international assets. But in my opinion, even if investors aren't selling US stocks, it's more likely that they're just not buying them, and instead they're switching to other international assets like those in Europe. Actually, the trend so far this year has been very clear in this direction. If you've been following me, I mentioned this just yesterday. Taiwan, for example. This year, the Taiwan stock market opened at almost 29,000, if I remember correctly. And at that time, as I mentioned, right around January 2nd, the market immediately picked a direction and everyone just rushed upward. That's exactly what happened. The same goes for the Japanese and Korean stock markets. After that, Malaysia, Singapore, Thailand, and all the European markets experienced similar situations. Basically, in January, there was a very strong rally across the board. So, for example, the FTSE 600 even hit a new intraday high just yesterday. So overall, the performance really does show this kind of trend, meaning that people aren't necessarily buying US stocks, but may be more inclined to buy stocks in their own local currency. Okay, so this is basically what Morgan Stanley's latest report is saying, that this new order will indeed allow other markets to perform better. And then, as we mentioned yesterday, there were rumors that Japan and the US had already reached an agreement, but the latest update is that the Japanese Ministry of Finance has directly clarified the situation. Although there has been some progress, there's still no concrete decision on what exactly to invest in. So basically, yesterday's news was more like a political statement. There's nothing definite at this point. In the end, the real question is, what exactly are they going to invest this $550 billion in next? Next, markets expect both headline and core year-over-year CPI at 2.5%, with month-over-month at 0.3%. You have to wonder what the actual situation looks like. Looking at the entire swap market, the estimates aren't really that pessimistic. For example, the latest swap trades in the market are around 2.48, which is actually pretty close to the Bloomberg consensus. The difference isn't really that big. Bloomberg itself estimates 2.4, but the overall consensus is about 2.5. So right now, there really isn't a huge discrepancy in the market. So as long as the downward trend can continue and stays in line with market expectations, basically the market's concerns in this area will likely ease up a bit. So in this situation, why do I say that Trump is compromising for votes? The reason is this: because Trump's poll numbers have actually hit a new low, and the latest case is with Gallup. After conducting their most recent poll on Trump, Gallup announced that they would no longer survey US presidential approval ratings. Trump seems to want to lash out at them, but whether there really is a lot of underlying pressure behind this, we can't be sure. But as far as the facts go, that's the situation. Trump's poll numbers really do keep hitting new lows. From one perspective, maybe that's not such a big deal. Aren't a lot of politicians polling low these days? But the problem is this. Looking at the upcoming House elections at the end of this year, it actually seems like the Democrats' chances of winning are getting higher and higher. Just something to keep an eye on. Basically, the Democrats don't even have 50% support, so it's not that people really love the Democratic Party, but rather that they feel forced to support them. So now there's this kind of vibe, where it's basically like having two rotten apples, and you're forced to pick one of them. And the reason why people are stuck choosing between the two mostly comes down to the effects of Trump's own policies. So what are the main effects here? The biggest one is that Trump has always insisted that he didn't cause inflationary pressure, but in reality, it's Americans who are actually bearing the burden of higher prices. So just how much of a burden is it? We'll talk about some related news in a bit to give everyone a reference. And next, this slide is something I think is really important. Looking at the past 2 decades since the year 2000, there have been 3 people, 3 presidents who have been elected to a second term: George W. Bush, Obama, and now Trump. For the second terms of the first 2, their midterm elections, basically none of them ended well. None of them had a good outcome. As you can see, for all of them in their second term, they started off at a high point when they took office, and then it just kept going downhill. Even Obama, who was loved by so many people, started his second term at a high point and then just kept hitting new lows over and over again. For about a year or so, it basically stayed at a relatively low point, just stayed low. And as for Bush, he even hit a record low less than a year into his term. He had already hit the lowest level, and that time for Bush was during the 2006 midterm elections. In those midterms, the Democrats had a massive wave, flipping both chambers completely. They basically took both the House and the Senate, and by a large margin. They led by a huge margin and won an incredible number of seats, so that time was truly an absolutely massive wave. Nancy Pelosi broke the Republicans' nearly 12 years of long-term control over both chambers in one fell swoop. So that year, the Democrats were really strong. That's why Obama was able to win so beautifully in 2008, because in 2006, the Democrats' wave effect was extremely powerful. And then, moving on, 2014. During Obama's second term, the Republicans took control of the Senate and expanded their majority in the House. They had already secured the House before, and then they took over in 2017. Generally speaking, it's not easy to win the Senate. In midterm elections, flipping the Senate is usually much harder. But in 2014, the Republicans even took 3 chambers and then widened their lead in the House, which they already controlled. So if history tells us that with such low approval ratings, midterm elections never end well, and now Trump is facing the same kind of low approval ratings, is it possible that by the end of this year, he might at least lose the House? Or even, to some extent, see a repeat of what happened before, with the Democratic wave flipping both chambers? Actually, looking at the seats up for election this year, The chances of a flip are not zero. The probability is definitely not zero. So if this does happen, it would basically be a major political setback and blow for Trump, and it could even have a very negative impact on his future prospects. So regarding this issue in the UK, why does he have to compromise for the sake of votes? The latest talk is that there are currently rumors going around. Actually, it started today, with the earliest report coming from the Financial Times, and then many other media outlets quickly followed up, with even more insider information coming out. Basically, what they're saying is that Trump might be considering narrowing the scope of tariffs on steel and aluminum products. He might reduce it. The main reason is that the original scope was so broad that anything containing those materials would be fully taxed, and basically no one knew how to calculate it. At the same time, the EU itself is also planning to impose restrictions, and this is something everyone should pay attention to. I think it's really important. The Office of the Trade Representative is busy dealing with a series of complex issues that arose from the hastily implemented tariffs last year. Personally, this is how I interpret it. The underlying meaning of this whole statement is that tariffs may need to be adjusted. The tariff policy might undergo some major changes, and basically, companies have already been informed that adjustments are being drafted. However, exactly how and when these changes will be made is still uncertain, but it looks like they will happen. So why do they need to make these changes? According to the original source, the latest research reports from New York Fed have already shown that last year, 90% of the tariffs were borne by American businesses and consumers, and that's based on data up to November. In fact, for the first 8 months, 94% of the tariffs were completely passed on. So what happened after November? Well, foreign manufacturers were able to absorb a little bit more. Basically, for every 10% tariff, export prices dropped by about 1.4%. But overall, Americans still shouldered 86% of the burden. Still, 86%. So basically, all the tariffs imposed last year, all the tariff payments, and all the revenue collected by the Treasury, Americans were the ones paying for it. It was hardly paid by foreign manufacturers at all. So the tariffs collected last year were basically just a kind of domestic consumption tax. So essentially, for Trump, this actually has a very long-term negative effect. Because basically, when he collects money, it's all from Americans themselves. In the end, this dissatisfaction will just keep building up. So in order to prevent this kind of resentment from eventually affecting his midterm elections, he absolutely has to address it well before the election, not just a month or two before, but a long time in advance. Honestly, I think it pretty much has to be now, February or March, before the 1-year anniversary of the tariffs. He has to make major adjustments to his tariff policy. As for how exactly he'll make those adjustments, we don't know, but he has to do it, because once he makes those changes, basically for the whole situation, both the product structure and price structure will undergo significant changes, because starting from April this year, tariffs will be in effect, so you'll see a strong performance. Actually, the mechanical effect of the tariff impact basically starts from March, so as long as you make adjustments to tariff-related measures, or even cancel them before or around that time, you'll already have addressed the tariff issue. Basically, this will have a very strong negative effect on the subsequent positive impact on inflation. In other words, inflation could experience a one-time significant drop, and such a sharp one-off decline could essentially become a reason for the central bank to continue cutting interest rates. So this corrective measure, right now the market estimates that the rate cuts won't be that large, but that expectation could be reversed. And for consumers, for the general public, for the stock market, and for all businesses, this would be a very, very significant impact. Also, regarding the rise in tariff costs, basically it's not just about, something simple. It's not like everything left China and went back to the US. Most of it just moved from China to Mexico and Vietnam. So, in effect, Trump didn't achieve his political goal, nor did he accomplish what he kept claiming, that because of these tariffs, all manufacturing would return to the US. That really hasn't happened, because basically, most of the manufacturing that did return to the US was based on infrastructure, on factories, and on an industrial revival, not really the return of consumer goods. Consumer goods haven't actually come back to the US, so this is, I think, looking ahead from an election perspective, this is something he'll definitely have to adjust eventually. Alright, so this is also just for your reference. I saw something pretty interesting today, and here I specifically used Brembo to help illustrate this chart for everyone. Right now, it looks like, remember at the beginning of our news segment, we mentioned that maybe international assets or international stocks might perform relatively well. So at this point, is it possible that Asian stocks could do well too? The correlation between them in the US, there's a chance that their correlation could separate, could diverge. And once that happens, usually what we see is that international markets, especially Asian stocks, tend to be stronger, while US stocks are relatively weaker. In other words, Asian stocks stop following the US market. It's possible that Asian stocks won't follow the US market, so is the current situation playing out in exactly the same way? Because once Asian stocks stop tracking the US market, if we keep watching the US market to make decisions about Asian stocks, there will be a big contradiction and conflict. That's why I wanted to bring this up in advance, since we already have the data to give everyone a reference. Now, why are we looking at the US dollar trend? Well, actually, since the year 2000, basically, every time the correlation is relatively high, it happens when the US dollar index is at a relatively high point. Almost every time, it's at a relative high for that period. Almost every single time. Here as well, the dollar kept weakening, and the correlation also kept dropping. And here too, the international stock markets were relatively strong. Same thing here. Around 2006 or 2007, the dollar was also relatively weak. And then, looking at the overall correlation, even though there was a new high here and it did break out a bit, overall, the correlation kept declining afterward. Then here, which should be around 2016 or 2017, that was also a relative high point, and then it went down. The overall correlation also trended downward. And then more recently, like in 2019, it was the same story. It was the same situation around November 2019. The correlation really widened out completely. So when the correlation widens like this, it doesn't necessarily mean that when international stock markets go up, US stocks will fall by the same amount. Sometimes it's not that absolute. It just means they don't move up or down together as closely. So they don't completely move up or down together. In this kind of situation, it's important for everyone to really assess their own asset allocation. Even though we're mainly talking about US and European stock markets here, this is just some advice and a reference for you. When international stock markets are relatively strong, should you consider, besides US stocks, also investing in other international markets? European markets, Japanese markets, and even other markets could all be directions worth considering. It's not just about focusing solely on US stocks. And if that's really the case, is it possible that when the US dollar is weak, stocks within the US market that benefit from a weaker dollar might also become a relatively important trend? Because that's actually what's happening now. The US dollar has once again reached a relatively high point. Basically, the overall correlation has completely diverged. The correlations are starting to separate entirely, and recently they're pulling apart even more. So if the US dollar continues to weaken and depreciate further, could it mean that the benefits it brings might gradually deepen as well? Pay attention, I think this is definitely a direction everyone should seriously consider, especially if, as we just discussed, tariffs end up being compromised for the sake of votes. So it's possible that the rate cuts could exceed expectations, and the US dollar could weaken even further. There's a chance the dollar could become even weaker. This would likely be a relatively favorable scenario for international stock markets, and Asian stocks in particular. Alright, so let's talk about industrial stocks and the situation with cyclical sensitivity. The main point is, have you noticed that these few stocks, well, maybe you haven't really heard of them, but a few years ago, they actually complained quite a bit. They felt that their situation in the Chinese market was really bad, so their outlook for the future was honestly pretty pessimistic. Also, these companies mainly manufacture agricultural machinery. And a few years ago, it was FedEx, and now it's the airlines. They all used to complain about their internal demand, and that external demand wasn't good either. But in their latest financial reports and all their public statements, they're all saying the worst is almost over, that the bottom is about to pass. This turnaround is actually pretty significant. So if you're thinking about investing in industrial stocks, personally, I would recommend going with the established, old-school industrial companies. So the kind of old industrial stocks with a lot of capital are good, but which stocks are actually sensitive to inflation? Actually, have you noticed that this one is an oil and gas company, and it's also an industrial stock, heavy industry? Then there's SLB, which is also an oil and gas company. Then there's Weatherford, which is also an oil and gas company. Next, there's Element Solutions, which deals in chemicals that are also related to oil and gas. Then there's plastics. After that, we have steel and aluminum, which we talked about yesterday when we discussed chemical stocks. So basically, the stocks that are currently most sensitive to inflation and most closely related to it are still mainly oil related. And chemicals as well. So basically, these two main sectors are still the focus. Then there's this company, Small Fit Waste, which does packaging. So it's similar to what we talked about yesterday with IP, which is International Paper, and also what we mentioned on Monday about American packaging companies. They're all based on a similar concept, and their outlooks for the later stages of the cycle are all showing an upward trend. Alright, now let's talk about RIC today. As for Generac, to put it simply, it's basically a generator company. It completely benefits from the demand for generators, so its overall future outlook is very strong. Why? Because standby generators are going to be essential equipment for future data centers and factories. Why is that? Because the power grid infrastructure in the US is inadequate. So while GE is still working hard to build out the power grid, what do you do if you still need backup power? Well, basically you have no choice but to use generators. That's why these generator manufacturers are planning for long-term growth. That's also why their EPS and revenue can keep growing steadily over time. It's because this long-term potential demand is extremely strong. So as American manufacturing and industry rise, basically all the related companies will rise across the board along with them. Then their expected growth rate basically rebounds as well. What does that mean? It means that growth isn't being driven by mergers and acquisitions or all kinds of special methods. Instead, it's entirely through their own internal growth that they're able to recover and grow again. To achieve business growth, it has re-entered an upward trend. It's back on the rise, but the company's own internal growth capability is actually very strong. To put it plainly, its long-term business growth rate has rebounded. Its long-term competitiveness is also rebounding, so for a revitalizing company, this is already good news in itself. Also, its price-to-book ratio is relatively low compared to its historical levels. Not extremely low, but it's at 4.8. So compared to its historical lows, it's still relatively low, and it's still very far from its previous all-time highs, really far. So the question is whether it has a chance to benefit from the overall recovery in demand and the revival of the manufacturing sector, and whether it can actually drive a more significant increase in its stock price overall. So I'll just go ahead and say that it's likely to benefit from the whole Made in America trend because of this concept. And then when you add in integrated circuits, whether it's the demand for semiconductors or for data centers, at the end of the day, to put it bluntly, everyone talks about the shortcomings. But even with those shortcomings, you still have to figure out what to do about it, right? Since you already know about generators, so today, RIC, so GNGRNC itself, could potentially benefit from this area. And for the believers, basically, it's already pulled back several times, so its bullish trend is probably going to start forming gradually. So that means, even in the recent period of volatility, wow, in the past, it was also a direction worth considering for building a position. And next, comfort. So basically, it's one of the main highlights. As a manufacturer of heating, ventilation, and air conditioning, it's about to make a comeback. Basically, it's a mid-cap indicator stock, so its long-term trend is even stronger. Its EPS, shown in white, has also been growing year after year. Its total capital really exploded. Did you notice that in 2024 there was a huge jump right here? With the transformation of data centers, it means that within the US, there's a need for more air conditioning equipment, more ventilation systems, and more refrigeration. Basically, more cooling equipment. The demand for these has surged dramatically, and after that, the demand has basically stayed at this high level. It just keeps going up and up, so if you look at its revenue and net cash flow, they're all continuing to climb steadily. Basically, it's all tied to data centers and enterprise clients, so the money these companies spend ends up in their pockets. Companies like Oracle, Google, and CodeWith, all the money these guys spend, it all goes straight into their pockets. So as long as the construction of data centers doesn't stop for a single day, then their business will keep growing. So basically, if you're still really interested in investing in AI, personally, I lean toward buying this type of company. The kind that's directly making money, the ones collecting payments from others. So you shouldn't buy the kind of companies that spend money, you should buy the industrial type companies that collect money from others. I think, relatively speaking, they're more stable in the long run, and the market is likely to recognize that as well. Fortunately, companies like Bilibili are in agricultural machinery, and Deere as well. Over the past few years, they've basically been in long-term decline, mainly because the most important markets, including the US itself, haven't been making any investments. China hasn't invested much either, and in Germany and Europe, there's been hardly any investment at all. So in recent years, investment in agricultural machinery has been seriously lacking. But right now, what they're seeing is basically 2026 is about as bad as it can get. It's unlikely things will get worse than 2026. 2026 will just be the bottom, and after that, things will start to recover. So they believe that investment going forward should rebound significantly because over the past few years, there's been a serious lack of investment in agricultural machinery and related equipment worldwide. So basically, you have to make up for that lack of investment going forward. If you don't, there will be major problems with supply and demand. That's why they see this as a potential area for growth in the future, especially since its net value hasn't dropped to an extremely low level yet. But its net value is still relatively low compared to historical levels. What's interesting is its momentum. The market is already starting to price in that the worst is over, so in a way, the momentum here is quite strong. Basically, every time, like in this case, during the entire period from 2020 to 2021, the rise was entirely driven by this. The worst is over, so every time it finds this kind of the bottom is behind us situation, the stock price reaction is usually pretty strong. Alright, let's talk about FedEx. I've followed them for years. And honestly, they've been complaining for a long time. They've complained from 2023 through 2025, claiming demand is weak, spending is down, and nobody's using them for various reasons. So have you noticed that their complaints are actually justified? Because if you look at their actual revenue numbers from 2022, 2023, 2024, all the way to 2025, it's been declining year after year. Although their profits might have held up due to structural adjustments and various one-time things like layoffs or cost optimizations, their EPS hasn't actually dropped year after year. But their revenue has indeed been declining year after year. However, by 2025, the entire structure will have been completely overhauled. They believe that starting from 2026, things will keep improving and they'll enter a growth phase. As for their cash flow, they think that from here on out, it's all about making money. Basically, after 2026, it's just going to be non-stop profits, and they'll only make more and more. So even FedEx, which is one of the most traditional logistics companies out there, really the classic example when it comes to the fundamentals of the economy, even they have this outlook. So tying this in with what we talked about yesterday, which is logistics, so when it comes to the trucking sector, is it possible that what we're seeing in the US right now is really a Main Street recovery, a true revival of the real economy? In other words, it's not so much about financial attributes, but more about actual production. It's really a shift, a genuine adjustment in material civilization and material living standards, a real revival in the quality of material life. So if this is really the case, then all the companies related to this sector, their operations and their profits are very likely to see a significant and structural improvement. Alright, so basically, I think it's already entered a stage where it's starting to rise on the right side of the curve. If you're looking to get involved, my personal suggestion is the same as before, since it's currently consolidating, going through a period of sideways movement, basically forming a platform at its current level. There are two ways to approach this. One is to chase the breakout, buying as it breaks out and rises. The other is to buy gradually on pullbacks, taking small positions as it dips. Actually, the stocks we're recommending right now have already gone up, so my advice here is either to go for a breakout and chase the momentum, or to wait for a pullback and aim for a good range during the consolidation to build your position. Personally, I recommend using this kind of strategy for trading. Alright, next up is Baker Hughes, BK. Actually, they're a specialized drilling service provider, and if you notice, their EBIT has been growing year after year. Really, it's been increasing annually. So for oil and gas companies, and for drilling service providers like them, it means that future profits are likely to keep getting better and better. But clearly, everyone around the world thinks that oil prices are getting lower and lower. So how is it that their profits keep improving? This is actually a pretty interesting situation, and basically, they've already broken out of a multi-year trading range. They're pretty much up here now. Everyone saw a clear breakout in mid-January, so it's actually entered a multi-cycle phase. That means it's very possible that this entire consolidation range will now serve as a really strong support, and it could be entering a much stronger bullish uptrend phase. Next up, this is ESI, which stands for Element Solutions Inc. It's actually a company that produces chemical products, and they provide chemicals related to mining exploration, as well as some chemicals used in plastics manufacturing. So in this round, basically it looks like, hey, it's also hitting new highs. It's already reaching new highs. Looking at its overall structure and its own profitability, it's basically expected to keep performing well going forward. Actually, it's pretty much the same for everyone. They're all in a similar situation. So right now, there really aren't any companies that stand out in particular. It's pretty interesting. In the past few years, all the companies I just mentioned were complaining, saying, oh, this year's going to be bad, last year was already bad, and this year will be bad too, and it looks like next year won't be any better. But in the latest quarterly earnings reports this year, every single company said, things will start getting better this year. And that's really interesting. What exactly did they see that made all of them unanimously say that things might keep improving this year? I think this is something everyone should pay special attention to. Have you noticed that none of the mainstream media are talking about this perspective at all right now? So is it possible that people will only start discussing it after the market has already gone up? A true major revival of industry. So take this as a reference for everyone. Alright, next, in about 40 seconds, we're about to get the CPI announcement, so let's switch over and take a look at the CPI situation. At the same time, there will also be an annual revision, but there won't be any data for that here. Then, looking at the MOM, the core CPI, its MOA is 0.3, which will rise from the previous value of 0.2 to 0.3. Meanwhile, the regular CPI will stay at 0.3. So whether it will be higher or not, I think that's actually one of the more important things to watch today. Although the market isn't particularly optimistic right now, and most people think there might be a noticeable rebound, let's keep watching to see what happens. Will there actually be a more noticeable change? Or at the very least, will it meet market expectations? That's something everyone can especially look forward to. Alright, in 4 seconds. The results are out. Hey, all of them. CPI is lower than expected. So overall, the CPI is below expectations, and the core CPI is in line with expectations. So that's actually good news. So right now, it does look like the US dollar is showing signs that a rate cut might happen, and expectations for a rate cut are rising. The same goes for US Treasury bonds, they're up as well. So basically, with the expectation of a rate cut, there should be a rebound, and it seems like there is one. Just now, actually, the S&P 500 futures were down. They were dropping, and so was the Nasdaq. And this is the Dow Jones. The Dow Jones, yeah, this is it. Yeah, this one's a bit delayed. It doesn't update in real time. It's just a quoted price. So sorry, this one might not be the best to look at. Let's just go straight to the Nasdaq. Alright, the Nasdaq, I remember it was actually down quite a bit just now, down by about 0.28 or 0.38, but now everything has turned positive across the board. Everything's in the green now, so this is actually a pretty big boost for the market. Basically, that's what it means. We can start to expect and look forward to the possibility that inflation might actually come down even faster. So is it possible, especially if we tie this back to what we talked about at the very beginning, if, for example, because of concerns about votes, he decides not to completely remove tariffs, but maybe just adjust them instead? Basically, the more he adjusts, the less and less impact tariffs will have on businesses, and the faster and faster inflation can drop. So is it possible that before Wash even takes office, Powell himself might cut rates by another quarter or half a point? Is that possible? I have to say, we can't completely rule it out. Really, we can't rule it out entirely. Alright. Now, let's take a look at the euro. Hopefully, the euro will just keep fluctuating slightly, and as the dollar weakens, the euro will probably keep moving up. The euro will likely continue to rise. Alright, European stocks should also benefit from the recently released CPI data, and will likely move upward again, and the euro as well. Yesterday, European stocks also hit a new all-time high during the session, and they should probably follow US Treasuries with a chance to keep rising, and a chance to keep going up. Okay, so let's go ahead and take a look at which sectors are currently the strongest before the market opens. Before the market opens, the strongest sector is still semiconductors, especially because the earnings report released late last night was really outstanding. Basically, across all their segments, whether it's memory or various types of semiconductor demand, the demand is extremely strong. So essentially, semiconductors are back to their original fundamental strength. The demand for basic raw materials is also very strong across the board. Actually, most of the current anxiety people are feeling is mainly on the services side, or in the AI sector, which was extremely hot last year. But have you noticed, aside from TSMC, Let me be blunt. If you take out TSMC, which was last year's hot stock, most of the stocks that are feeling pressure this year are the ones that were popular last year, except for TSMC. All of them were the same group of stocks that were extremely hot last year. And the stocks that are performing really well this year are basically the ones that nobody seemed to be paying attention to last year. So could this be a shift in the nature or rotation of different sectors? Maybe that's actually a really important trend for this year. I think this is something everyone should keep in mind as a reference. But I still want to emphasize again that TSMC is an exception. TSMC is in a category of its own because it belongs to AI, it's also part of the industrial sector, and it's the leader in semiconductors, so it really should be considered separately. So don't get overly anxious about AI stocks, and then because of that also get worried about TSMC. Honestly, I have to say these are two completely different things. They're totally unrelated. TSMC's industrial attributes actually set it apart from that group of AI stocks. It's even stronger. TSMC is all about making money. It makes money off this whole group. It's earning profits from all these AI companies. So this is actually a pretty different situation, and it's something everyone should really think about. You really need to separate TSMC from the rest. Alright, let's take another look. So if everyone really takes the long-term approach, and since we're talking about international stock markets, their performance should be relatively better. Also, that decoupling between US stocks and international stocks, or between US stocks and Asian stocks, I think could gradually become more and more obvious. Actually, so far this year, it's already been pretty obvious, and it's possible that this trend of decoupling could last the whole year. I think it's entirely possible for it to last at least another 6 months or more. Alright, US Treasury bonds continue to decline. And as for US stocks, we'll see. When the market opens, at least in the short term, the pressure isn't as great as before. So everyone can look forward a bit more to the possibility of rate cuts. Alright, now let's take a look, since we haven't discussed this yet. Okay, the Japanese yen. Alright, someone just asked about the yen, so I'll go ahead and take a look at the situation with the yen here. Personally, I have to say that the possibility of the yen completely weakening this year is not very high. Here at 160, that's an absolute defense threshold. It's a hard line of defense. As for whether the yen can go on a long-term rally, that's still uncertain for now. But at least from the relationship between the US and Japan, it's unlikely that the yen will accept or continue to weaken over the long term. It's unlikely to accept a further decline simply because none of us right now can say for sure. After all, Mayor Gao hasn't clarified his upcoming tax cuts or various fiscal policies. What exactly is he going to do? So the market doesn't dare to fully react to this situation either. That's why I think personally, I wouldn't really recommend using the yen as your main trading currency. Honestly, I wouldn't suggest it, because it's just too heavily influenced and disrupted by policy. Really, way too much. So it's possible that while other Asian currencies are strengthening, the yen could just keep doing its own thing over there. Let me put it this way about this big range. The high point is this gap up, this big gap, and it just keeps fluctuating up there. It might keep moving around in this area, and I think that's definitely possible. Meanwhile, other Asian currencies might actually be getting stronger, because there's also another hope for the yen. The renminbi, the RMB, has really just kept getting stronger and stronger. The RMB has honestly just kept strengthening all the way. So you see, the RMB has been getting a lot stronger, but as a result, the yen is still just stuck there, and the big range is still just fluctuating. So personally, I really don't recommend using the yen as your main trading target, but as long as you're investing in Japanese stocks, I basically think you don't really need to worry too much about losing out on currency exchange. I don't think it'll get to that point. I also don't really think there will be much loss, because basically up here is an absolute resistance level. This is an absolute defensive threshold, so it's pretty unlikely that the yen will depreciate significantly. I think that's just not going to happen. So if you already hold yen or Japanese funds, or if you're already investing in Japanese stocks, you don't need to worry about suffering big losses just because you're holding a large amount. I really don't think that's likely. And for those of you who are thinking about traveling, go ahead and spend on your meals if you can. I want to ask, do these tiny decimal differences really matter? For consumers, the difference is negligible, so don't worry. That's the yen situation. Here is a reference point for you. Alright, so overall, that's how things are with the yen. At most, I think before their policies are all finalized, it'll just fluctuate at a high level. Basically, it'll just move within this big range. So that's pretty much it. This is just for your reference. Any other questions? If there are no more questions, then we'll wrap things up here today. Thank you all so much for listening. I wish you all smooth trading, and since the new year is coming up next week, I want to wish everyone a happy new year, a wonderful year of the horse, and may you get rich quickly. May good fortune come your way right away, and may all good things happen to you immediately. So, best wishes to everyone. Happy New Year. See you next week. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.